You open your brokerage app in 2026, and the S&P 500 is sitting near a record high. Your first thought is simple. I missed it. The good entry point is gone, and now all that's left is the risk. That one sentence is the most expensive thought in investing, and almost everyone has it at some point. Here's the problem. That feeling isn't new. It isn't specific to this year, this Fed meeting, or this AI rally. It's the same feeling investors had in 2013, in 2017, in 2021. The market kept hitting new highs, and people kept waiting for it to come back down before they'd get in. Some of them are still waiting. So let's actually look at what a record high means, because most people get it backwards. A record high isn't a warning sign. It's just what a rising market looks like along the way. Stock prices don't climb in a straight line up from a low point and then sit at the top forever. They climb, pull back a little, and set a new high again, over and over, for decades. If you only buy after a big drop, you're not being careful. You're waiting for an event that might not come for years, while your money earns nothing. This is exactly what Burton Malkiel argued in his book, A Random Walk Down Wall Street. Malkiel, an economist at Princeton, studied decades of price data and found that short-term stock movements are close to unpredictable. Not because the market is random chaos, but because prices already reflect everything investors currently know. That idea is called the efficient market hypothesis. In plain English, it means that by the time you feel confident the market is about to drop or about to rise, that information is usually already priced in. You're not actually one step ahead. You're guessing just like everyone else, and guessing has a cost. Every year, a research firm called Dalbar publishes something called the Quantitative Analysis of Investor Behavior, QAAIB for short. It tracks what the average investor actually earns, compared to what the market itself returned over the same period. And year after year, the average investor earns noticeably less than the index they're invested in. Not because their funds perform badly, because of when they bought and when they sold. They pile in after the market has already risen, out of fear of missing out. Then they panic sell after it drops, locking in the loss right before it recovers. The fund did fine. The investor's timing didn't. Why do smart, capable people keep making the same timing mistake? This is where psychology comes in. Daniel Kahneman, a psychologist who won the Nobel Prize in economics, spent years studying exactly this with his research partner, Amos Tversky. Their work became known as prospect theory, and one of its core findings is this: losses hurt roughly twice as much as equivalent gains feel good. A 10% drop feels far worse than a 10% gain feels rewarding. That imbalance is called loss aversion, and it explains almost everything irrational about how people invest. It's why a dip triggers panic selling. It's why a rally triggers the opposite fear. The fear that if you buy now, you'll be the one holding the bag when it finally corrects. Either direction, the emotion is steering, not the math. So what actually works? Let's walk through two people starting today, in the exact market you're looking at right now. The S&P 500 near record territory. Inflation sitting around 4%. Its highest point in 3 years, and the Federal Reserve holding its benchmark interest rate, the rate that shapes borrowing costs across the entire economy, in a range built to slow inflation without breaking growth. The first person decides to wait. They tell themselves they'll get in once things calm down. Once inflation drops, once the Fed cuts rates, once there's a pullback that feels safer. That moment of comfort never quite arrives, because the market doesn't wait for comfort to make new highs. A year passes. Then two. Their cash sits in a savings account, quietly losing purchasing power to inflation every single month it isn't invested. The second person does something almost boring. They put a fixed amount into a low-cost S&P 500 index fund every single month, regardless of what the headlines say. Mark it up. They buy. Mark it down. They buy more shares for the same dollars. This approach has a name: dollar cost averaging. And it removes the one variable that wrecks most investors: trying to guess the perfect moment. Let's put a real number on that. The S&P 500 has historically returned somewhere around 10% a year, on average. Before inflation, closer to 7% once you account for it. That doesn't mean every year. Some years it's up 20%. Some years it's down 30%. But averaged out over long stretches, that's roughly the pattern. Now picture putting $500 a month into a broad index fund and never touching it. After 10 years, at that average pace, you've put in $60,000 of your own money, and the account is worth closer to $100,000. After 20 years, you've contributed $120,000, and compounding has turned it into something closer to $350,000. You didn't do anything clever in year 15. You didn't call the bottom or the top once. The growth came from time being left alone to do its job, which is the entire point: compound interest. Albert Einstein reportedly called it the most powerful force in the universe. And whether or not he actually said it, the math behind it is very real. Here's the part that surprises people. Go back to someone unlucky enough to start investing right before October 2008, at the worst possible moment, just as the financial crisis was about to erase nearly half the market's value. If that person panicked and sold at the bottom, they got destroyed. But if they kept contributing the same amount every month, straight through the crash, through 2009, through the next decade, their terrible timing barely mattered. By 2020, time in the market did more work than their entry point ever could have. The investor who timed it wrong but stayed in still beat the investor who timed it right and then sat in cash waiting for the next dip that never came on schedule. That's the counterintuitive twist most people never sit with. Waiting for the market to feel safe isn't the cautious move. It's the expensive one. Cash isn't neutral. Inflation is actively shrinking what it's worth while you hold it, waiting. Every month you wait for certainty is a month. Compound growth doesn't get to work on your money. This is also why John Bogle, the founder of Vanguard, spent his career pushing a strategy that sounds almost too simple to be advice. Don't try to find the one stock or the one perfect fund manager who will beat the market. Buy the entire market through a broad, low-cost index fund and hold it. Bogle used to say, don't look for the needle in the haystack, just buy the haystack. And the data backs him up. S&P Global runs an annual report called the SPIVA Scorecard, comparing actively managed funds against their benchmark index. Over 15-year periods, the large majority of actively managed U.S. stock funds, consistently more than 8 in 10, fail to beat a simple index fund, even after all their research, all their trading, all their fees. The people paid to time the market and pick winners mostly can't do it either. None of this means 2026 is a guaranteed winner, or that stocks only go up from here. There will be pullbacks. There might be a sharp one. Inflation could stay sticky longer than expected, and interest rates could move in a direction that spooks the market for a while. Right now, a lot of that record high is being carried by enthusiasm over AI infrastructure spending, massive investment in data centers, and computing power. That kind of concentrated excitement has a history of running hotter than the fundamentals underneath it. And a broad index fund is partly your protection against that, because it doesn't bet everything on one story staying popular. It owns the whole market, the boring companies along with the exciting ones. None of this is a reason to avoid investing. It's a reason to be honest about what money you're using. Before any of this applies to you, The boring first step still matters. An emergency fund, 3 to 6 months of expenses, sitting somewhere safe and liquid, not in the market. Money you'll need in the next year or two for a house down payment. Or a wedding doesn't belong here either, because a market that's up 10% this year can just as easily be down 15% the year you need to withdraw. This strategy is for the money you genuinely won't need for 5, 10, 20 years. Given that timeline, short-term drops stop being emergencies and start being exactly what the SPIVA data and the Dalbar data already told you to expect. Noise on the way to a much higher number later. So here's the mirror. Right now, today, you're probably doing exactly what the person in this story does. Checking the number, feeling like it's too high, waiting for a sign that never quite arrives clearly enough to act on. That instinct feels like patience. It's actually the same fear Kahneman documented, the same gap Dalbar measures every year, wearing a more comfortable disguise. The version of you a decade from now doesn't need you to predict the next dip, guess the Fed's next move, or find the one hot stock before everyone else does. It needs you to open that same brokerage app, not to check whether you missed it, but to put something in. Automatically, every month, in a low-cost index fund, regardless of what the headline says that day. You open your brokerage app in 2026, and the S&P 500 is sitting near a record high. This time, that isn't the moment you decide you're too late. It's the moment you finally start.